Hello and welcome to the current events segment of Making Sense of Markets, Quarter 3, 2016. Now, I don't know about you, but I don't think there was a single day during the last quarter when I didn't hear something about the upcoming election. Yet most of the noise around the election was more likely to incite fear or anger than to prompt long-term critical thinking. Recently, Bankrate.com asked investors what the largest threat to the U.S. economy was over the next 6 months. And it turns out it wasn't worries about interest rates or a decline in the stock market or even terrorism that scared people the most. Instead, with 61% of the results, people said that the next presidential election was the biggest threat to the U.S. economy. Turns out that same anxiety or fear is shared by economists. Shown here is the rising number of economists responding that the election process is having a somewhat to significant detrimental effect on the economy. As of September, more than 60% of respondents shared that fear. Meanwhile, 20% of S&P 500 companies mentioned the presidential election in their latest quarterly earnings call as a possible red flag. But is this concern borne out by historical data? We looked back at the last 6 presidents, which happened to be evenly split between 3 Democrats and 3 Republicans. And what you'll notice is that the returns are basically random. They aren't all good or all bad for either party. During the Carter administration in the late 70s, stocks rose even during stagflation. Reagan was in the White House during the 1987 Black Monday stock market crash. George H. Bush saw mainly positive gains heading into the 90s, while Bill Clinton was in office during the boom years of the late 90s and was on the way out just as the tech wreck started to take hold. George W. Bush came into office as the economy was struggling, saw several good years in the mid-2000s, but was in office as the economy turned down in 2008. Barack Obama has seen positive gains in the S&P 500 during his tenure in the White House. We've looked at longer-term numbers as well, and we always come to the same conclusion that you simply can't predict market performance based on who's in the White House. Nevertheless, it's natural to look at the current election and to search for any clues as to how a potential win by either candidate would impact your investments. Come election day, the general market consensus is that a Clinton win would be seen as a continuation of the status quo, and so would likely not be seen as a dramatic impact. Conventional thinking is that a Trump victory could lead to a bit more volatility simply because there's more uncertainty around areas such as trade relations or foreign policy. Now, this isn't to say which candidate's policies would be best for the economy in the long run. It's simply reflecting that markets generally prefer less uncertainty to more. But how much impact will the next president actually have? Well, by one measure, whoever wins in November will actually have less latitude to spend money or to cut taxes than any president since World War II. I dug into some numbers from the Congressional Budget Office and found that the share of government spending which is discretionary, things like military, infrastructure, those topics you often hear a candidate discuss, have been falling dramatically over time. Mandatory spending, which includes things like Social Security, veterans benefits, and Medicare, are more or less locked into place and they're growing quickly, meaning that there's a smaller and smaller piece of the pie for which a president can actually impact. And the president isn't acting alone. Keep in mind there's the House, the Senate, state governors, mayors, and so on that all impact government spending. One of the most common concerns we heard in this industry following the 2008 presidential election was that an Obama victory would be bad for the economy and bad for investment. Yet we should keep in mind that stock prices are impacted by hundreds of individual factors: the quality of their products, the cost of manufacturing, exchange rates around the world, company innovation over time, etc. Policies that the president can impact are only one piece of the puzzle to determine a company's value. What is clear from this chart is that investors who panicked with worries about what might happen during an Obama presidency missed out on tremendous gains over the last 8 years. And in particular, those who worried about healthcare reform might hurt companies in that sector saw the exact opposite. with the healthcare sector of the S&P 500 significantly outperforming during those years. So I'd encourage you to go out and cast your vote on November 8th for whoever you feel will do the best job as our next president. But when it comes to your money, invest in a way that makes sense for the long term, regardless of the outcome this November.